Hi, welcome to the Alliance Group Accelerated IPO and Group Rollup Model. My name is Anthony O'Leary and I'm the CEO here at Alliance Group, and we are a mergers and acquisitions and private equity company. We're based in 5 continents worldwide, and essentially what we do here at Alliance Group is we take companies public on the stock exchange for the sole purpose of rolling up the industry and creating an industry dominating public holdco group of synergetic companies to really generate a magnitude of impact on growth that, quite frankly, most entrepreneurs don't know is possible. So what I'd like to do today is to share some value creation strategies with you. I'd like to start getting you to think differently about growth. I basically want to take you from effective thinking into efficient thinking, because look, the business world is constantly changing, but most entrepreneurs and most founders don't change with the times. And what I'd like to do today is to open your mind to a whole new way of thinking and introduce a few new strategies that might get you thinking into how you could actually grow your business with exponential growth over a very, very short period. Now, look, as a business owner, look, you obviously have an organic growth strategy combined with a sales and marketing strategy, and typically what tends to happen is that you dedicate the time and you invest the necessary funds into implementing this strategy on the hope that you're going to grow your company year on year, on the hope that you're going to increase your customer base, you're going to increase revenues, but also as well, most importantly, that you're actually going to increase profits. Now look, listen, that's a fairly long slog to go through. Now I'm here to tell you that you don't actually have to run the marathon. You can actually run the last 10 yards and you can still win a medal. That there are basically strategic routes to get you to the finish line much easier without incurring all the blood, all the sweat, and basically all the unnecessary years that it takes to normally achieve success. And this is a real new discovery, because there are businesses out there today that are currently trading in your industry. They're selling the same products that you're selling, and they've already invested all of the time, all the money, all the resources, all the blood, all the sweat, all those painstaking years, and they have already acquired the customers and the databases that you so much long for. Now, this is a real game changer when you think about it, because now instead of going out and looking to acquire a customer one by one, now we can actually take a look at it from a different point of view, and we can actually look at going out to market and acquiring a whole bunch of customers that are already under one corporation that you are already serving. And there are really only 2 options for growth for people, for founders, or for entrepreneurs looking to grow their business. Option number 1, the slow traditional model. And basically what that is, you continue growing at the same pace that you have been, using the exact same model and methods that you've been using. And basically what you're trying to do is you're trying to generate a year's worth of sales during a 12-month period. And you're hoping to increase that by a 10 to 20% margin at the end of the year. Because look, typically with most small to medium-sized businesses, if you have an increase in revenues or in profits of 10 to 20% a year, it's traditionally classed as a pretty good year. Now, the second option really that I want to open your eyes to here is the Alliance Group way. And the Alliance Group way is basically implementing an IPO and combining it with a mergers and acquisitions strategy. And this really is a complete game changer when it comes to growth for small to medium-sized businesses. So the diagram on this screen represents a company that has went through the IPO process, and then by using mergers and acquisitions has acquired 5 of their competitors. Because when you implement an IPO combined with a mergers and acquisitions strategy, this is where the magic really starts to happen. Because essentially you supercharge your growth by acquiring 1 or more of your competitors, and you grow by essentially a year's worth of revenue in an afternoon. And the beauty about this is it can be done multiple times throughout the year. And it really is like strapping another engine on the airplane to generate a magnitude of impact on growth that, quite frankly, just would not have been possible by using other traditional methods. And the beauty about this strategy is that it can be implemented over and over again. It's just not 1 competitor that we can actually help you acquire. It's 5, it's 10, it's 15, even 20. The opportunity is absolutely endless, and it really is only limited to your own desires. But as you can see on the screen here, this is a very good representation of what can happen when you could take a company through the IPO process and then start implementing a mergers and acquisition strategy combined with that IPO. It is a true game changer that can create generational wealth that just would not have been possible had you stayed a private company. So, how do we buy up all these companies? Where does the money come from? How do we essentially build your brand after you've been listed on the stock exchange and really generate that accretive shareholder value by building out a group of companies like we spoke about on the previous slide? Well, in order for us to answer these questions, first I'd like us to take a look at some of the traditional methods or some of the traditional options available to somebody who's looking to do one of these roll-ups. Now, traditionally, if a company wanted to implement this strategy, then they would actually have to approach a bank or a large corporation to secure a loan or to create essentially an acquisition fund to go off and acquire these companies. Now, as you know yourselves, banks are notoriously difficult to deal with, and trying to secure large funding like this from them, even if they are interested, you can be expected to put your whole life on the line to fund the venture with personal guarantees, liens on family homes, you name it, they'll want you to put your whole life on the line in order to get this cash. Now, something that I suppose a lot of people don't actually realize is a more important factor than that is that you're also loading up the original business with massive amounts of debt, and you're also giving away most of your forward cash flow for the next few years to actually service this debt. So it's a really, really risky model, borrowing money from banks to perform these sort of roll-up strategies. Now, the other option then, or the other two options that we're actually left with is private equity and venture capital. Now, private equity typically don't get interested in any deals unless they kind of hit that barrier of about 100 million, between 100 to 200 million. And look, venture capital are laser focused on kind of these tech startups in the hope that they're going to find the next kind of unicorn to list on the exchange. So with both of these models as well, what happens is you actually relinquish a large amount of control actually in your own company. So a lot of the times investment banks and venture capital funds, if they are actually willing to help you out and to back this venture, they will actually want to install one of their people on the board. A lot of the times they will want to put one of their people in as the CEO of the company. And what you'll actually find is that you'll actually, over a period of time, and it's normally a very short period of time, you'll actually lose a lot of control of the company. So here at Alliance Group, if we do decide to do business together, we've absolutely zero interest in putting a member of our staff on your board. So we do not want a board seat. We will not be installing anybody as a CEO. And most importantly, we have zero interest in interfering with the management of the company. So we really take a complete different approach here and really allow you to stay and remain in control of your company, because essentially we are under no illusions. This is your company. Now, how do we go off and, I suppose, generate and acquire all these companies? Well, it's a really interesting question, and basically what happens is when we do an IPO and you actually list on the stock exchange, we now have a form of currency, or a new form of currency that previously had not been available to us. And that new form of currency is the public shares that are actually listed on the stock exchange. So because your shares are now listed on the exchange, they have a demonstrable value. There's actually a tangible value attached to your shares that are listed on the exchange. Now, something really interesting happens. So just for example, if you're earning 1 million in net profits per year, and we'll say for this example, you're trading at a 20 times multiple, that would mean that you would have a market cap of 20 million. Now, we'll say that you go through the IPO process and Alliance Group goes out to market and we start building relationships with some of your competitors, and we go through negotiations and we come to some agreements that we can actually purchase your competitors. Now, bearing in mind you're doing 1 million in net profits and you have a market cap of 20 million because you were trading at 20 times earnings. Now, just for example, we go out to market and we now agree to acquire your competitors at 10 times earnings. And just for this example, we'll say that it's a company in your industry, one of your direct competitors, and they are doing 1 million in net profits as well. So now we've just agreed to acquire a company doing 1 million in net profits at a 10 times multiple for 10 million. So simply what we do is we issue 10 million of new shares in the PLC, in the publicly listed entity, to acquire that company. Doing 1 million in profits. Now, immediately after that transaction, once we acquire that company, we've now acquired a company for 10 million, but immediately after it's been acquired, it's automatically now worth 20 million, because as part of the PLC, it's now trading at 20 times profits. So now, just for example, we've issued 10 million worth of new shares to acquire a business that's immediately worth 20 million. This is really where the magic starts happening and where we start benefiting from that arbitrage in valuations. And the beauty about this strategy is that it can be done multiple times throughout the year. So we now go out there and acquire your first competitor. Now something truly magical now starts to happen that essentially bends the laws of physics. We call this the 2 + 2 = 5 rule. So what happens is after you acquire your first company is you'll soon realize that there's actually a lot of duplication. You will now have two companies selling the exact same products, selling the exact same services, and making the same 1 million in net profits per year each. But now you will also have two sets of sales departments, two marketing departments, two IT departments, two HR departments, two office spaces, two accounting firms, two attorneys, and so on and so forth. So there's a lot of duplication, as you now have two of almost everything. Now, after assessing the synergies, you normally will come to the conclusion that you actually don't need two of everything. You don't need two IT departments, that your IT department can handle the majority of everything. You don't need two attorneys, you certainly only need one. You don't need two HR departments. Your HR department has more than enough capabilities to deal with the HR problems and the HR aspects of the actual business. So what happens is that one of these companies is generating 1 million net profits per year, but now doesn't need all of these expenses that are normally attached to the year and the running costs of the company. So now all of those expenses, once they are cleared, are added immediately to the bottom line, and the profit now has actually increased without actually increasing any revenue. And this is actually the magic of acquisitions. So now instead of having two 1 million profit companies, each making a combined 2 million profit, now all of a sudden you're making 3 million profit in combined, because you've now gotten rid of all of the expenses of one company but maintained all of the profits and all of the revenues. Hence why we call it the 2 + 2 = 5 rule. Now, when we implement this strategy on a larger scale, say with 10, 15, 20 companies, you start seeing some absolutely amazing numbers that totally transform the profits of the group itself. Now, another thing that happens now as a larger company with larger revenue, you now have more buying power. So you can essentially enjoy the economies of scale by leveraging your collective size. Things just really get a lot easier when you're public and you're much bigger. You can now renegotiate with suppliers as you're now placing larger orders in bulk. This will obviously result in the ability to purchase raw materials at a discount if you are in an industry that requires raw materials. You now have wider access to different services that are just not available to private companies. Bank charges come down, credit processing facilities come down. It really is a game changer. And now you have access also to unique banking products as a publicly listed company that previously weren't available to you. So there is a lot of meat on the bone here, and there's a lot of advantages to being a public company. Now, the final point I'd like to touch on here is that Alliance Group charges 0 fees for using this whole strategy. So we make money by taking equity in the actual IPO itself. So we're on board with the whole journey, and we're as vested in the actual success of this group and the IPO as much as you. So we jump on board as a strategic partner. We pay for everything. We pay for all the listing fees, we bring on all corporate advisors, we bring on corporate attorney, we have investment banking relationships that we bring on board as well. We cover all the costs of that. We do a pre-IPO raise and we do a cap raise should one need be. And then, as I said, most importantly, what we do then is we go out to market and we acquire your competitors and bring them in underneath your umbrella to create that accretive shareholder value. Now, obviously, we make money by taking a stake in the IPO, so we're as vested in this process as you are. So we jump on board as strategic partners wanting the same amount of success in this IPO and group roll-up model as you do yourself. So, in summary, we offer a capital markets and mergers and acquisitions alliance to supercharge your growth. We lift up the bonnet of your business to show you all the benefits of listing on the stock exchange and combining an M&A mergers and acquisitions strategy with that IPO. You will discover a blueprint to success to consolidate and roll up your industry, to extract value from your company while still continuing to grow. So now, if you do want to sell down 2 or 3% of your company to go off and buy that Ferrari or that beach house, it's actually possible because there's a ready-made market of investors waiting to buy your shares. That's the benefits of being a public company. So if you're in the market for growth and you would like to grow by a year's worth of revenue in an afternoon multiple times throughout the year, then reach out to us here at Alliance Group and we will start exploring options to see what sort of possibilities there are for you and your business. Thank you very much.